In part 2, we're going to do matching. We're going to take a look at the parts of the, this is basically Chapter 2, Conceptual Framework. The accounting assumptions, principles, constraints, and characteristics are listed below. We'll talk about those in just a moment. We're going to select those that best justify the following accounting procedures. So we're going to relate the principles to the accounting procedures, the procedures to the principles, and match them up. It's possible that a letter may be used. So let's get started. Up here, you'll see here are the terms that we're going to be using, the concepts, and down below. So it says, number 1, choose the solution that will be least likely to overstate assets or income, and that's going to be our conservatism. It turns out that conservatism, I'll use a capital letter, is not really listed anymore. It's practiced. We're going to come across it lots throughout the semester, but it's not part of the conceptual framework. We recognize that it exists, but it's not part of the conceptual framework of what we're trying to get toward. And that's because it violates the notion of neutrality. Number 2 says describing the depreciation methods used in the financial statements. Here we're talking about full disclosure. How did we estimate depreciation expense? That's going to be this full disclosure over in L. Number 3 says applying the same treatment to similar accounting events. All right, so now we're talking about here is a degree of consistency. And that's going to be E. We're consistently applying accounting principles. So we do it this way in 2011. We continue on and do it again in 2012. And that way our results are going to be consistent. Consistency, E. Number 4 says the quality which helps users make predictions about present, past, and future events. Well, this is going to be what we refer to as relevance. It has to do with predictive ability, which is part of relevance, and B, it's predictive ability. Number 5 says recording a transaction when goods or services are exchanged for cash or claims to cash. That has to do with when we've recognized revenue, and I think K is the best answer there. We recognize revenue when it's realized, when there's been a transaction and there's been an exchange for cash or claims to cash. That's the realization. Number 6, preparing consolidated statements. Well, that has to do with our economic entity, the entity concept. F. Number 7 says information must make a difference or a company simply need not disclose it. And here we're talking about primarily B, relevance. Relevance really defines that. If it makes a difference, it's relevant. Otherwise, a company need not disclose it. Number 8 says provides the figure at which to record a liability. Well, we normally start out with historical cost, A, to record a liability. So if we get a loan for $50,000, we get some cash of $50,000, and that's our historical cost. The preparation of timely reports on continuing operations. And that's in number 9. What we're talking about here is periodicity. We want to know how well did we do along the way. So we'll do I, periodicity. We want to break it up, and we'll call that yeah, periodicity. Number 10, the accrual accounting. We're not talking about going concern here. Accrual accounting says that we're going to recognize revenues when they're earned, that's K, and expenses when they're used up. So here I would accept either J or K. And so here we're going to have J and K there. In number 11, recording those items that are significant enough to affect decisions, select 2. Okay, so this is number 11. So relevance matters. Is it big enough to affect a decision? Clearly that's relevance means it affects a decision. Another one would be cost constraint would fit in there. Significant enough to affect a decision is the cost constraint says, are the benefits larger than the costs? You could also argue that it could be expense recognition and revenue recognition. I think the main ones here are going to be B and G. I would argue they're big enough. Those are the ones that are most important here. Number 12, additivity of financial statement figures relating to different time periods. And here we're talking about the monetary unit. We're assuming dollars are the same, and it doesn't matter whether they're $2010, $2013, they're all additive. Ignoring the phenomenon of price level changes, in other words, don't use historical cost. What we're really talking about here, again, is this monetary unit. Number 14 is not reporting assets at liquidation costs. That's because we assume that we're going to go on into the future, and as a general rule, we start with historical cost, not how much we can sell it for. And so, going concern, D is the right answer there. Number 15, characterized by completeness, neutrality, and being free from error. What we're really talking about here is the overall concept of faithful representation. That is M. We're going to be talking about establishment of an allowance for doubtful accounts. Here it has to do with several different things, I suppose, but the one that comes up is expense recognition. You could also argue conservatism. I think both of those, expense recognition and conservatism, are reasonable arguments, but J is better. I'm going to list it first, and then H. Because even if we get rid of conservatism, as FASB has tried to do, we still are going to have the allowance. That's because of the expense recognition. So I'd put J first. Number 17 says use of estimating procedures for amortization policies, like we estimate how many years. Choose the straight line method. Select 2, but do not use periodicity. No. And this is 17 and 18. That's going to be one of them is going to be, well, we're spreading these out into the future because we assume that we're going to be around. That's the going concern. And the second one would be, okay, well, we recognize an expense as it gets used up, and we're just choosing a method that does the using up. All right, in this one, we are to